Thank you. Thank you. Hello. Good morning, everyone. I will do the presentation in English. I hope that's okay for you all. If I go too fast or something like that, just raise your hand and I'll try to rephrase it or talk a bit slower. So I'm active under the name Compounding Quality, and the topic of today's call or webinar of presentation. You see that I'm used to give digital meetings, right? So it's really nice to see you all in front of me. So today we will talk about quality stocks. So also during the presentation, if you have certain questions, just raise your hand. I think it's really beneficial for both of us if we can make this as interactive as possible. So the topic of today's call, well, what will you learn over the next 45 minutes? Well, first, the essence of quality investing. What is quality investing all about? Then, how can you identify quality stocks? So when you look at it, there are 6 essential characteristics every great stock or every compounding machine has. We will go over that. Next part, well, I will give you or I'll show you how you can identify these companies yourselves. I'll also give you some examples to make everything more clear. And at the end, I also have a small gift for you. So I definitely advise you to stay tuned and try to learn as much as possible from this presentation today. So maybe a brief introduction. Who is Compounding Quality? Well, I'm active mainly on Twitter and LinkedIn. Almost 400,000 followers there. And I basically tweet and write about general investment concepts, examples of quality stocks, things like that. I used to work in the industry as a professional investor, so managing an equity fund. But to be honest with you, when I joined, I was very skeptical against the industry. Why? Well, as you know, most professionals don't outperform the market. There are a lot of commercial incentives. A lot of people think on the short term, and everyone knows that you should think on the long term, and things like that. And to me, after working there for a few years, well, all the traditional sayings you hear from Wall Street were true. So a lot of funds make decisions to basically take money out of the pockets of their clients and to benefit from that themselves. That's why the account was created. And right now, 400,000 followers across social media and a website, compoundingquality.net, where 3 investment articles are written per week. You get an insight in the portfolio, investment cases, investment courses, stuff like that. So let's get into the essence of quality investing. But first, let's be honest with each other. If you look at the facts, if you look at the numbers, you will notice that 90% of professionals underperform the market. And it's not something to bash on professionals. The same is true for non-professionals or retail investors. As a matter of fact, when you look at retail investors, the numbers look even worse. So they're around 95% underperform the market. And to me, that's really sad. Why would you pay 1.5 to 2% a year to get a product, an investment product that underperforms, basically? That's really sad, but it's also quite funny at the same time. And to start with that, well, I have a ridiculous riddle for you. How do you put an elephant in the fridge? Is someone brave enough to give an answer? There are no wrong answers. You want to? Yeah. So basically, when an adult is asked this question, he says, well, it's not possible. I don't know. I am going to zig the elephant in pieces and put it in the fridge and stuff like that. Well, when you ask this question to an 11-year-old, he has a very simple answer. He says, well, I open the fridge, I put the elephant in, and I close the fridge again, and it's done. And it's keep it simple. And that's exactly the same in investing. So some of you will know this quote from Albert Einstein. The essence in life and also in investing is to keep things as simple as possible, but not simpler. So remember, 90% of all investors underperform the market, but as a matter of fact, there are a lot very simple strategies, very common strategies, easy to use strategies that tend to do really well on the stock market in the long term. To give you a few examples, by the way, the data on the slides are from 2 books, Stocks for the Long Run from Jeremy Siegel and What Works on Wall Street by James O'Shaughnessy. So some examples of easy-to-use strategies, value investing, for example, when you just buy the 20% cheapest stocks on a PE ratio, so very easy, very straightforward, where you outperform by more than 3% per year. Size matters, also in investing, so small cap investing, when you just buy the smallest stocks in the investment space, well, in the long term, so over the past 100 years, you outperform by around 4% per year on average, and the same goes for quality investing. So there's a Morningstar Wide Moat Index, and if you solely would buy companies with a competitive advantage, well, in that case, you do 4% better than the index on average. And as most of you probably will know, when you're able to outperform by a few percentage points over long periods of times, well, amazing things happen to you. That's how the magic of compounding works. That's how compounding machines are created. So to summarize this slide, well, most investors underperform, but by using a very rational and strict investment framework, well, you can actually do well on the stock market. So we already briefly touched on this. Small cap investing, so if you just buy the 10% smaller stocks, well, you do on average 4% better per year than the index. And Warren Buffett, everyone knows Warren Buffett, so from Berkshire Hathaway, obviously he's one of the best investors of the world. He outperformed by a wide margin, but when you look at his outperformance, it went something like this. It was really high, and then it started declining and declining and declining, and over the past 10 years, it has even been negative. What is the main reason for this? Well, it's quite simple, actually. It's the law of large numbers. So Berkshire Hathaway today is so big that he can basically only invest in the real mega cap names in order to make an impact on Berkshire. And Warren Buffett has also said that when he would manage 100,000 or 1 million today, that he would have no problem to make a return of 50% per year. So what did he say in one of his annual letters? Well, if you want to do well as an investor, you should go where competition is weak. Where is competition weak? In the small and mid-cap space. And that's maybe one of the main takeaways from working in the industry myself. I managed a rather small equity fund, around 200 million in assets under management. But even we, and 200 million is really small in a global perspective, certainly on Wall Street. Even we couldn't invest in small caps. We seldomly invested in mid caps. So basically, professionals aren't just looking there. So fund managers aren't looking there, and analysts also aren't looking there because fund managers can buy them, so it doesn't make a commercial incentive to do that. So small and mid-cap space can be really interesting. Another question for you. What kind of investor is Warren Buffett? Someone brave enough this time to give an answer? I'll answer the question for you. So basically, when you ask this question, most people say Warren Buffett is a value investor. And that's true, especially in the beginning of his days. He was a deep value investor. He bought really cheap stocks based on traditional metrics such as the PE, the price-to-book ratio, and so on. But to me, Warren Buffett is a quality investor. So the last few months I've spent reading everything Warren Buffett has said and written. So you see the photo on the right hand of the slide. It's an underestimation to say that it took me a while. But one of the key takeaways I took away from reading that is that Warren Buffett was a quality investor, and Warren Buffett was a quality investor way easier than most people think. So what he says in his annual letter of 1972, so 1972, that's more than 50 years ago, he says, well, I try to buy companies when 2 criteria are met. So 1, I want to return on equity on average over the past 10 years to be higher than 20%. And 2, I want to return on equity over the past 10 years to have never been below 15%. So Warren Buffett, 50 years ago, he already looked a lot at quality metrics like return on equity, like return on tangible assets. 1972, it's also no coincidence that that is the year that Buffett bought See's Candies. Maybe one important extra thing to notice on this slide, well, obviously in the beginning, Buffett was a value investor, and under influence of Charlie Munger, he made the evolution to, as you can see, buying wonderful companies at a fair price. Now, the essence of quality investing. What is quality investing? If you put it really simple, well, quality investing is about investing in the best companies in the world. And how can you do this in 3 easy steps? It's based on the philosophy of Warren Buffett on the one hand, and also on Terry Smith from Fundsmith on the other hand. Well, 1, you try to buy wonderful companies, so great companies. 2, led by outstanding managers. And then last but not least, you are trying to buy these wonderful companies led by outstanding managers at a fair price. Next question that might arise to you is maybe, does it work? The simple answer is yes, it works if you use it with a sound and rational investment strategy. We already touched about the Morningstar White Mode Index. Well, when you look at the MSCI World Quality Index, you see that this index outperformed by 3.5% per year since 1994. So the MSCI World Index basically just picks the companies with the highest quality in the MSCI World. And then obviously compounding quality also has its own investable universe, and this universe outperformed by 6% per year on average. Maybe something important to add here. I'm not here today to say that quality investing is the investment method and that everyone should use it. What I think is important is that you try to define for yourself what kind of investor you are. And it can be value investing, it can be growth investing, it can be dividend investing, minimum volatility, quality. So pick a strategy that you feel comfortable with, and also one that is or that managed to work really well in the past, so that there's a strong track record here. So next part, the tempo of the presentation and the English, it's okay for you guys? Okay, perfect. So next part, now we learned the essence of quality investing, or the definition. When we are going to look at the characteristics, well, we see that each great company basically is characterized by 6 things. So 1, they have a competitive advantage or a moat. They are doing something unique. Really important. Quality investors will never invest in a company that doesn't have a moat. Second point, skin in the game. So insiders are still involved in the company, the founder is still leading the business, things like that. Third point, a low capital intensity. So companies that don't require a lot of capital in order to grow. Fourth point, capital allocation. What is the company or what is management doing with the free cash flow it generates? 5, well, you want those companies to be very profitable, obviously. And then last but not least, you want the historical growth and also the outlook to be attractive. I think this one is a really important slide, and that's why we'll also go over these 6 characteristics over the next few minutes. So first, we start with the moat, or the competitive advantage. You only basically want to invest in companies with a moat. Companies that do something unique, companies where it's really difficult for competitors to basically enter the industry and take market share. Warren Buffett said that he only invested, or only wants to invest in companies within the circle of competence. Well, how does he define his circle of competence? 1, he should understand how the company is making money. And 2, he should be able to make an educated guess about how the industry, but also about how the company will look like in 10 years. For example, it's really difficult, or at least for me, maybe there are some experts here, but it's really difficult for me, for example, to estimate about how the market for AI, how the market for cybersecurity will look like in 10 years from now. But what you know is that in 10 years, everyone will still be brushing their teeth, drinking Coke, drinking coffee, things like that. So you are trying to buy companies with a moat, companies that do something unique. So you really don't try to invest in companies that are basically the next big thing, but invest in companies that have already won. How are you going to quantify this? Really important. We will come back to this later. But you are looking for companies with a return on invested capital larger than 15% and a gross margin larger than 40%. And that's not everything. You also want the gross margin and the return on invested capital to be very robust, very stable. And when you find these kind of companies, you know on the one hand that the company has a moat, and on the other hand that the company has pricing power, which is also an attractive characteristic. Maybe go briefly over this slide due to timing concerns, but what 5 kinds of moats a company can have? Well, a company can have a competitive advantage based on 1, intangible assets, 2, the switching cost, the network effects, cost advantages, and efficient scale. What is the most important source of moat? Well, it's a moat based on network effects. Every one of you knows companies that have a moat based on network effects. What is a network effect? A network effect is when the company is becoming more valuable, when the moat is growing, when more companies or more people are using the product or service. What is an example of that? Well, Meta platforms or Facebook. All of you have probably already used Facebook or Instagram or WhatsApp today. Well, the more people use these kind of programs, the better it is for Facebook. Another example, Facebook, Visa and MasterCard, for example. The more people use the payment network, the harder it is for stores and things like that to decline Visa and MasterCard. What is the weakest source of moat here? And academic research has also proven that it's a moat based on cost advantages. So that one I would avoid personally. What is a moat based on cost advantages? Well, it's usually in cyclical industries, commodity-like industries, where the company is doing it cheaper than its competitors. But our world is continuously changing, so it's really hard to remain or to keep that advantage. What can be an example there? IKEA, for example, or Ryanair, companies like that. So what we did here, first point, we studied the competitive advantage, and companies with a moat outperform on average by around 4%. Next point we're looking at, skin in the game. So what you want is you want the interests of management to be aligned with the ones of you as a shareholder. Why? Well, there are a lot of companies, a lot of big companies that don't have skin in the game, and you see it a lot. They acquire another very big company for a really rich price, for really lofty valuation levels. Why do they do that? Well, because then their company is bigger, they get a larger bonus, their prestige is higher, things like that. But what you want is to invest in companies that put the creation of shareholder value first. Well, how are you trying to look for these kind of companies? Well, look for companies that are still led by the founder, so where the man who founded the company is still running the place. Let's give some examples, maybe MedSpace, OTC Markets, Evolution Gaming, Kelly Partners Group, companies like that. Or you want insider ownership to be higher than 3.7%. We already talked about the moat. Companies with a moat outperform by 3% per year on average. Well, here on the right hand of the slide, you see a study from Credit Suisse, the Family 1000 study, and this one concludes that family-led businesses outperform by 3.7% per year on average. So let's make it clear what we are doing here. We are taking different characteristics, moat, skin in the game, and things like that all on its own already tend to do well on the long term. And when you combine these kind of criteria, you are building some kind of watch list to base your investment decisions on. And that's why I would say that at least in the long term, I tend to feel quite comfortable to say that the watch list, for example, we are creating based on these criteria should tend to do really well in 10 years, 20 years. So here you see a slide or a snippet from a slide from Kelly Partners Group. Kelly Partners Group is a company we own at Compounding Quality, and he basically, he's a complete Buffett freak, but more on that later. But what does this slide show? Well, that founder-led businesses outperform the market by 3.9% on the average. It's based on the book The Founder's Mentality. If people like to read, well, it's an excellent book tip. Third point, low capital intensity. So you want to invest in companies that don't require too much capital to grow. So again, when you would take the S&P 500, for example, or the MSCI World, and you would take a bucket with companies that don't require a lot of capital versus companies that require a lot of capital, and you would measure the performance of both in the long term, you'll notice that the ones that don't require a lot of capital tend to perform better. How are you going to measure this? How are you going to quantify this? Well, you are looking for CAPEX, or capital expenditures on sales, to be lower than 5%, and CAPEX on operating cash flow to be lower than 25%. A table on the right-hand slide, there you can see for the portfolio, for example, that CAPEX sales is 4% versus 19% for the S&P 500. So you'll see that you try to build a portfolio that don't require too much capital to grow. Fourth point, capital allocation. Really important one. Besides the moat or the competitive advantage, probably the most important metric. So capital allocation is all about the decision what a company is doing with the free cash flow or the cash it generates. When you have two identical companies, exactly the same valuation, fundamentals, exactly the same growth, but they make two totally different capital allocation decisions, the results will be really, really different over time. Now, which capital allocation decisions can a company make? In total, there are 4. So 1, they can choose to invest in organic growth. That's, at least to me, by far the most preferred one, especially when a company has a high return on invested capital and plenty of reinvestment opportunities. Second point, pay down debt. So can make a lot of sense when a company acquired another company, for example. They have a leveraged balance sheet today, and they want to leverage down a bit to make it more flexible. Third point, M&A. But please be wary of this, because the data show that around 2/3, around 70% of all mergers and acquisitions destroy value. What's the reason for this? Well, like we already briefly touched, some managers are making decisions for their own prestige, for their own personal agenda, instead of creating shareholder value. If you're looking at M&A, I would say or advise, look at the serial acquirers. Companies like Constellation Software, for example, Brown & Brown, Watsco, companies like that. So that's the third capital allocation choice. Fourth choice a company has is bring it or distributing it back to shareholders via dividends or share buybacks. How are you quantifying the capital allocation part? Well, you look for companies with a return on invested capital larger than 15% and a return on capital larger than 20%. Again, and the concept is clear here, when you would create a bucket with companies with a very high and sustainable return on invested capital, well, in the long term, you tend to do really well. Remember that almost no investor managed to outperform the market. By using criteria like this and by sticking to it, well, over time, in the long term, your results tend to be quite well. Fifth point, profitability. Makes great sense, I guess. The higher the profitability, the better. So you want to invest in companies that translate a lot of revenue into earnings, and also in companies that translate a lot of earnings into free cash flow. So the more profitable a company is, the better. How are you quantifying this? Well, you want a gross margin larger than 40% and a profit margin larger than 10%. If a company has a profit margin of 10%, you basically know that per $100 or €100 in sales, they make €10 in profit. So here you see also a snippet from the book, Stocks from the Long Run, from Jeremy Siegel. What this basically says is companies that translate most earnings into free cash flow outperform companies that translate the least earnings into free cash flow by 18% per year. So 18%. What's the reason for that? Well, maybe people or some of you have read the book The Outsiders from Thorndike, for example. Great capital allocators, great managers focus on free cash flow per share growth. And when a company doesn't translate most of its earnings into free cash flow, It's also an indication that the company might be active in, might be doing something fraudulent. They might make up the numbers and things like that. So that's definitely something you want to avoid here. Last part, secular trend or the growth part. Why is that so important? Well, this is really key. In the long term, stock prices always tend to follow the evolution of the intrinsic value per share growth. And I'll repeat it because it's so important. In the long term, stock prices will always follow the evolution of the intrinsic value per share growth. What is one of the main factors for the intrinsic value per share growth? Well, it's the earnings per share growth and the free cash flow per share growth. In other words, the stronger or the more attractive a company can grow, the better for you as an investor. And when you know this, I think it makes a lot of sense that when a company is active in a secular trend, so when a company is active in a market that is growing at attractive rates, that in that case, these companies, it's way easier for them to grow their earnings at attractive rates. What are some examples of secular trends? Well, think about obesity, a company like Novo Nordisk, for example. Urbanization, Kone, a Finnish company active in escalators. Digital payments, Visa and MasterCard. Cybersecurity, think about a company like Fortinet, for example. Stuff like that. Now, what are we looking for? How are we going to quantify this? Well, we want revenue growth to be larger than 5%, and also the earnings growth to be larger than 7%. And we want this to be the case in the past, but also in the future. So in other words, where a company managed to grow at attractive rates, but where we also think that the company will continue to do so in the future. Here's another snippet from a book, Only the Best Will Do. So what you basically see here is that you see the gray line, the earnings growth, the black line, the stock price. Well, in the long term, stock prices always tend to follow the earnings growth of a company. So we already briefly touched it. What we did here for each of the 6 characteristics, we took characteristics that on its own tend to perform already really well, and we combined them all into one stock selection framework. You can use it in a stock screener, for example. And by doing that, well, we are building a watch list that should perform already really well in the long term. So to give you an example here, the watch list of compounding quality has 139 companies, and over the past few years, it outperformed by 6 to 7% per year on average. Do I think this outperformance will continue in the future? No, I wouldn't say that, but it shows you that combining these criteria can be a good thing. So we talked about the characteristics now. Let's briefly recap it because it's really important. What you are looking for as a quality investor is you are looking for a moat, skin in the game, a low capital intensity, great capital allocation skills, high profitability, and last but not least, attractive growth or a secular trend. And when you're able to find companies that match or all criteria, that ticks all boxes, well, you've managed to find a potential compounding machine. So now you learned what quality investing is, what 6 essential characteristics are. Next part, well, now we know over what characteristics they possess. How I'm going to find them? And I think the first thing here to realize is you can't analyze everything. So worldwide, there are 60,000 listed stocks. 60,000, that's a lot. And I think we all agree that no person in the world is able to analyze it all, and especially not when you have a full-time job, when you're still studying, when you probably don't want to spend 24/7 on researching stocks. So what can help you here a lot? Well, we are using a stock screener to remove all the weeds, so the bad companies, and to be left over with all the flowers or the great companies. Personally, I use, for example, services like Bloomberg or Refinitiv for that. That's really expensive. Bloomberg costs around 2,000 a month, Refinitiv 1,000. The good news, well, you can also use a free screener like Stratosphere, for example, and there you can basically replicate this for free via your phone or the internet. So which criteria are we using to build or to start building an investable universe? Well, these ones. So what are you looking for? Net debt, EBITDA lower than 3. So you want companies with a healthy balance sheet. When a company has a healthy balance sheet, well, it gives them a lot of flexibility and stuff like that. Next thing, the attractive growth part, the secular trend part, where you're looking here for revenue growth larger than 7% and earnings growth larger than 9%. When you do this, you know that you found a company that managed to grow at attractive rates. Next part, return on invested capital, talks about the company's moat and the capital allocation skills. Return on invested capital, you want this to be higher than 15%. You also want to invest solely in profitable companies, so profit margin larger than 10%. And last but not least, well, operating cash flow on net income larger than 90%. Why? Well, we talked about the fact that companies that translate the most earnings into free cash flow outperform by a wide margin. Here we're using operating cash flow. Why? Well, simply because in Stratosphere, the free stock screener, you can screen for free cash flow on net income, but using operating cash flow is a great proxy. When you would do this exercise, and like I said, you can do this in 2 minutes yourself, you will find around 200 companies when you look for companies in Europe and the United States, and you exclude some cyclical businesses like commodities, the banking industry, and stuff like that. And as already mentioned, in the long term, I'm quite comfortable to say that just those 200 companies on its own should tend to do really well in the long term. Now, how do we build the compounding quality portfolio? Well, obviously, based on the quality investment framework, based on the 6 characteristics we talked about. And to split it a bit further, well, if you ask me, there are 3 attractive buckets of 3 attractive kind of stocks on the stock market. So on the one hand, you have the owner-operators. That's 60 to 70% of the portfolio. These are companies that are still run by their founder or where insiders own a high stake. Second bucket, monopolies or oligopolies. So industries where only a few players dominate the entire industry. That's interesting. Why? They don't have a lot of competition. They often have a lot of pricing power, high margins, things like that. And last bucket, quality cannibal stocks. So those are quality stocks that are heavily buying back shares. So here, one slide to go over each bucket. First bucket, owner-operator stocks. So companies where the founder is still leading the business or where insiders are owning a very high share. Why is that attractive? Well, family companies outperform by 3.7% per year on average, and founder-led business by 3.9% per year on average. So that's attractive. What are some examples? MedSpace, Evolution Gaming, OTC Markets, Kelly Partners Group, companies like that. Second bucket, monopolies or oligopolies. Only a few companies dominate the entire industry. Interesting, they have a lot of pricing power, not a lot of competition. And again, while you would make a bucket of monopolies and oligopolies, so companies that possess over these characteristics versus non-monopolies and oligopolies, well, the results tend to be really well. Examples, S&P Global and Moody's, for example, or MasterCard and Visa, which most of you probably know. Also here, some examples from Warren Buffett. When you analyze the current portfolio of Warren Buffett and also the historical portfolio of Warren Buffett, you'll notice that he really likes to invest in monopolies and oligopolies. Last but not least, quality cannibal stocks. This is maybe a bucket where not every one of you is familiar with. Well, these are quality stocks that are heavily buying back their own shares. And that can be interesting. Why? And before saying that, maybe mentioning it makes only sense for companies to buy back shares when the company is undervalued. But when a company buys back shares, for example, it buys back 50% of their outstanding shares, well, obviously that means to you as an investor that the earnings and the free cash flow needs to be divided by only 50% of the shares. So when they buy back 50% of the shares, the earnings per share and the free cash flow per share will double. And remember, in the long term, stock prices follow the earnings growth or the free cash flow per share growth. So when the valuation remains constant, well, in that case, your return will also be 100%. So here's an example where you can see the evolution of the outstanding shares of AutoZone since 2014. Well, they basically bought back 50% of their outstanding shares over the last 10 years. And if you go on Google and you look up the stock price, you will notice that AutoZone was a stock that you would have wanted to own since 2014. They performed really well. So you learned what quality investing is. We learned about the 6 essential characteristics of quality stocks. You can use it in a stock screener and identify them. And now let's give you, to finalize, 3 examples to make everything more clear. By the way, also, I think skin in the game is also very important. So the 3 examples I'm giving here is also why I'm invested in via compounding quality and also personally. First company, Ulta Beauty. Ulta Beauty is an American company and it's the largest US beauty retailer. So they offer more than 60,000 beauty products and they have the largest loyalty program in the US. To put it into context, some of you have seen or I saw some of you are drinking Starbucks. Well, Ulta Beauty's loyalty program is way larger than the one of Starbucks. Why do I think the company is interesting today? Well, first of all, it ticks all boxes, talking about the 6 quality characteristics. And secondly, it's a cannibal stock. So what they basically do is, I estimate that over the next few years, they will buy back 85 to 90, or they will use 85 to 90% of their free cash flow to buy back shares. And today, Ulta Beauty trades at the cheapest valuation level it has ever traded at. So they trade at a PE, price earnings ratio, below 15. And when you combine heavy share buybacks with the cheap valuation levels, well, beautiful things can happen to you. And you can also see the expected return there. Well, I always use an earnings growth model and a reverse DCF to value a company. Going into this would bring us a bit too far today. It's all on the website. But I think the essence here, well, via the earnings growth model, I calculate the expected return for investors. For Ulta Beauty, it's 13% per year, meaning, are you happy with a return of 13% per year? Well, in that case, you can consider investing in it. If you don't, you should look for other investment opportunities. And the other one is a reverse DCF, reverse discounted cash flow model. So reverse discounted cash flow model basically shows the growth, the market, so the growth the current stock price is expecting. And when you do the exercise for Ulta Beauty, you will notice that the market thinks that Ulta Beauty will grow by 5.5% per year over the next 10 years. Well, if my estimations, if my assumptions are correct, and they buy back 50% of their outstanding shares, well, just as a result of that, without any growth, the company should grow its free cash flow or should grow by 7% per year. So that's already more than the 5.5% per year here, which is why I think the company is undervalued. Next example for you, OTC Markets. American company, owner-operator stock. So Cromwell Coulson is a CEO since 1997, and insiders own more than 40% of the company. What does the company do? Well, they are the New York Stock Exchange of smaller companies. So what they do? They basically trade 12,000 over-the-counter securities. I think 2 weeks ago, I sat together with Cromwell Coulson, the CEO, and maybe an interesting takeaway here is that some of the people who invested in the early Buffett partnership in the 1960s are still invested in this company today. So it's really a company with skin in the game and with great shareholders. Obviously, I say people who invested with Buffett in the 1960s, that's more than 60 years ago. It's sad to come to the conclusion that obviously these people are most of the times 80 years old, 90 years old. So they are unfortunately passing away, but it shows you the great culture the company has. So expected return based on the earnings growth model, 12.4% per year. And then when you do a reverse DCF, the market thinks that they need to grow by 6.4% per year. My assumptions are that the company should grow its free cash flow per share by around 10% over the next decade. So the company looks attractive today. Last example, Kelly Partners Group. I assume that no one has ever heard about this company. If someone has ever heard about the company, can you raise your hand? Okay, we're in the same boat, that's cool. So basically, it's a really small Australian company. And what they do is it's a serial acquire. So they acquire other businesses, and they have a decentralized business model. So it reminds a lot of the business model of Constellation Software, for example, in Canada, which is a really great compounder. And what is so interesting about the company? Well, first of all, Brad Kelly, I met him a month ago, and he's a complete Buffett freak. So what he says all the time is, I'm trying to build the Berkshire Hathaway of accounting, and he's so obsessed, he constantly studies people like Warren Buffett, like Bernard Arnault from LVMH, or also Mark Leonard from Constellation Software. Another indication that the company has great shareholders, well, Lawrence Cunningham from the book Quality Investing, and also from was the vice president of the board of directors of Constellation, is also active in the board of directors of Kelly Partners Group and owns a significant stake. And also William Thorndike from the book The Outsiders is invested in the company. So Brad Kelly himself, he founded the company and still owns around 50% today. Insiders own 60%. Maybe last thing to add here, well, when I talked with Brad, he's really frustrated with one thing with his company. And what is he frustrated with? Well, it's the valuation. So right now, Kelly Partners Group trades at around 4.5 Australian dollars per share. Well, he thinks, but not my words, his words, he thinks that right now the company is worth at least 10 Australian dollars per share. And when we were talking, he showed me his own valuation model to value Kelly Partners Group. Well, do I think he's too optimistic? Without doubt. But in his valuation model, he estimated that his company, Kelly Partners Group, was worth 1.8 billion by 2030. Well, today the market cap is around 200 million, so that's 9 times as much. Is he too optimistic? Yes, for sure. But I think as well that the company is undervalued. They are expanding to the US today, and when they succeed in that, well, I think beautiful things can possibly happen. So you learned about quality investing, the 6 characteristics of quality stocks, how you can find them, some examples. Yeah, and maybe last but not least, a small gift for you. So on the website, compoundingquality.net, you get an insight in the portfolio. You get investment cases. So there are 40-page investment cases on Ulta Beauty, on OTC markets, on all the companies we talked about, basically. There are 600 PDFs with 300 resources on the website. Well, normally the price is, I charge $4.99 for that. What I'm willing to do here is, you can get a free trial by scanning the QR code or using www.compoundingquality.net/trial. If you do that, you can see basically everything behind the paywall for 7 days. So you can basically look at the portfolio, download all the investment cases, cancel your trial, and leave me alone. If you want to do that, feel free, but don't forget to cancel within 7 days, because otherwise you will be charged. But if you scan the QR code or go to the website, well, you can get a free trial. And I think that's it for, at least for me today. So if there are any questions, feel free to ask them.
I would like to ask you about what's your opinion on investing in banks, because Warren Buffett's second largest position is Bank of America, whereas other quality investors like Terry Smith, they completely despise investing in banks or other financial institutions.
So that's a fair point, and you see that with Warren Buffett and also with a lot of other famous investors. And don't get me wrong, Warren Buffett is 2,000 million times as smart as I am, but it's one of the points I don't agree with him. So if you look at the 6 characteristics here, well, when you just look at the banks, they don't fit these criteria. So they don't have a high return on invested capital. Most of the time, at least the large banks don't have skin in the game, stuff like that. So for me, basically, I try to exclude all sectors that I don't consider within my circle of competence or where I don't think they are attractive. So you don't want cyclicals, commodities, exposure to silver price, lithium price, copper price. Also not investing in banks. and things like that. So I don't invest in banks. Some companies, and I'm already telling you this, tomorrow the article will be published. On the other hand, I like some insurance companies. So you have, for example, a company like Brown & Brown. That's a company I'll announce tomorrow, and I will buy it for compounding quality on Monday. Well, these companies, also Kinsale Capital, they have still skin in the game. It's family-led businesses. They have more attractive fundamentals. So for me, these kind of companies are more interesting than the banks. But yeah, I would definitely say always stay within your circle of competence and invest in the companies that you feel comfortable with, because I think that's the most important. Because when you just follow someone else's stock tips and the stock goes down 20%, well, you will have a really difficult time to stick to the strategy, and you will probably make decisions that, in hindsight, won't be the best ones.
Yeah, I have two more personal questions. The first one is, when and how did you start investing for the first time? And the second one is if you have always kept the same quality investing philosophy.
Good question. I'll try to answer them shortly because so basically, when did I started investing? My first time, I think it was when I was 14 years old. And I can already tell you I was the worst investment ever. So I heard about investing from a friend on a summer evening on a barbecue, or from a friend of my father. I thought, okay, you can actually make money without having anything to do, without having to work for that. That's really cool. So next day, age 14, I created a brokerage account. The account was opened after a few weeks, and then I had no clue at all where the hell should I invest in, basically. So then, email from the broker, new adding to the top pick list, right? And I thought, these experts should know what they're doing, right? I blindly followed them, put all my money in the company, and after 1 year, I sold the stock. It were all the earnings from my summer job that summer, and I sold the stock minus 60%. So that was really painful for me, and I think when something like that happens to you, you have two options. You decide that it's nothing for you, and you just quit, and you start with bank funds or bonds or whatever. Second option is you become completely obsessed, and you try to learn everything you possibly can. And that's what I did. And from then on, I started reading books, podcasts, YouTube videos, newspaper, stuff like that. And to ask the second question, when or did you were interested in quality investing from the first time? No, I wasn't. So when I started working in the industry, when I started working as a professional investor, I mainly was invested in the companies from my own country, so the country I lived in. Not a good thing, a lot of home biases. But because I started working in the industry, the rule was, well, you can't own any stocks at all within the country you live in. Why? When you would buy the company for yourself and then for the fund, you push the stock price up. It's called fund running. It's illegal, so you couldn't do that. And that's basically where I needed to rethink my entire investment strategy. And that's when I started reading books like Quality Investing, Only the Best Will Do, How to Pick Quality Shares, books like that. And that, yeah, for me, it really clicked immediately. And that's when I started quality investing, and I would want no other way from now on. I hope it answers your question.
Thank you.
Thank you.
Ya damos paso al siguiente. We're going to move to the next presentation.